Welcome to the Deep Dive. We're here to cut through all that daily market noise and really focus on the insights that actually matter for understanding what's going on. Today, we are diving deep into a really dynamic 5 days the market action from September 8th through to the 12th, 2025. Just a fascinating week. Lots of shifts, some pivotal moves that tell a pretty compelling story, I think. And for this deep dive, we've been digging into our sources, mainly the Loop Market Briefing, and really getting into the weeds with the Loop Market Discussions, September 2025 daily briefs. Our mission, like always, is to kind of distill all that, pull out the key trends, maybe highlight some surprising facts or those aha moments for you. Basically help you quickly grasp what really moved the market during that specific week using that unique loop analysis lens.
Yeah, and that focused approach, that's really the value here, isn't it? These briefings, they're not just spitting out daily numbers. They're really designed to help you spot the patterns, understand those underlying currents shaping performance, and sort of piece together the narrative the market's trying to tell us. It's about connecting those daily dots the loop identifies. See the bigger picture.
Okay, let's unpack it then. Looking at that whole week, September 8th to 12th, what was the main story? What surprised you the most about how the market behaved based on what the loop was saying?
That's a good question. I think what stood out was this real split, this dichotomy. You had very clear, very strong leadership from tech. But alongside that, you saw this strategic, almost careful rotation into defensive plays. Even while, other parts of the market, certain sectors, certain stocks, showed this persistent, frankly, worsening weakness. The market wasn't just reacting, it was actively choosing. Technology and healthcare led initially. Tech then consolidated midweek, caused a bit of uncertainty actually before just roaring back. And all the while, consumer staples, they showed some real defensive strength, kind of a ballast.
Right, it's striking. Tech's roaring, but then financials and energy are just consistently lagging. What did the loop briefings suggest about why? Why were they so out of favor that week? And then you had these individual standouts like HPE and USPH just lighting things up. Totally different story from, say, Western Union WU, which had that prolonged red streak, that loop term for consecutive down days.
Exactly. And the Loop's daily discussions really brought that internal conflict to light. It wasn't some broad tide lifting all boats, not at all. It was deeply selective. This week, it really showed the market's pulse, not as one thing, but this complex interplay of conviction here, skepticism there. And those terms, red streaks, bright green heat maps, those loop indicators are just critical for seeing where that conviction actually landed.
Okay, this is where it gets really interesting. Let's talk about who was leading the charge and who is, falling behind in that sector race.
Yeah.
Starting with the big one. Technology. Yeah, our sources, especially those loop market discussions, consistently pointed to tech's strong performance. Monday, September 8th, right out of the gate, beat top performer. That loop designation, meaning you just smashed expectations, kept that momentum Tuesday, cooled off a bit midweek, which raised some eyebrows. But then Thursday, September 11th, boom, reclaims leadership. Right back in the spotlight.
And what's fascinating there, something the Loop briefing really dug into, wasn't just the price action, but the money behind it, the capital flows. Tech ended that week with the strongest inflows, big institutional money moving in, and it hit that bright green heat map status, which in the Loop system means top-tier performance, broad confidence. The briefing on the 8th even asked, very pointedly, is early tech leadership sustainable or just the start of a short squeeze? That captured the mood, right? Some initial skepticism. But as the week wore on, with those inflows staying strong and that decisive rebound, the market seemed to answer. By the 11th, the briefing just stated it, technology all beat strongest inflows. It felt like that early skepticism shifted towards, okay, maybe this is more fundamental strength, not just some technical squeeze.
Okay, switching gears a bit. What about the defensive side? Those strategic inflows. Healthcare played a big part, described as defensive positioning, holding gains, and by Wednesday the 10th, clear defensive inflows into healthcare staples. The briefing on Monday even asked, what role does healthcare rotation play? Seemed like a calculated safe haven.
Oh, absolutely. Classic risk-off behavior you see in institutional portfolios. Growth looks shaky. Money moves to relative stability. And consumer staples showed that too. Look at HSY, Hershey. By Wednesday the 10th, Loop had it as a beat, plus 0.9%, 3-day streak, strong defensive momentum. Then Thursday, still showing steady tape, calm trading, underscores the role. The discussion on the 10th asked, how long can HSY's defensive bid hold momentum? That wasn't just casual commentary, it's proving the market's commitment to safety. And HSY holding up suggested, there was real demand for stability that week.
But not everyone was having a good time. Financials, energy, persistent weakness there. Consistently tagged as lagging, underperforming, funds heading for the exit. Financials called weak on Tuesday 9th, and by Thursday 11th, Loop sees funds rotating out. A really clear pattern.
Indeed. And energy, particularly, highlighted Thursday 11th as the weakest sector again. Both were described as being drained of funds. That's a strong signal from Loop's analysis. Institutional capital actively leaving shows a real lack of conviction. It wasn't just a dip, felt like a fundamental rethink of those sectors, maybe tied to macro stuff like rates for financials or geopolitics for energy. Tells you investors were being choosy, not just pulling back everywhere.
So this selective movement, what does that tell you about the underlying market mood? It paints a picture of, well, very discerning investors.
Precisely. It tells us institutions weren't just knee-jerking to headlines, they were making strategic adjustments, rotating into perceived strength, perceived safety, and actively selling areas where conviction just evaporated. It's a nuanced sentiment, far from a simple bull or bear market. The Loop briefing really helped clarify that differentiation.
Okay, let's zoom in. Specific names from the watch list. These stories really bring those sector trends to life. Offer some aha moments. First, HPE, Hewlett-Packard Enterprise, an emergent leader that week. Yeah, HPE kicked off Monday, September 8th as a beat top performer, exceeded expectations in that breakout plus profit zone, the Loop Systems indicator for strong buying, potential for more gains, then showed repeat breakout behavior above $25.20 on Tuesday. Just kept pushing higher, riding that tech wave.
But what's insightful from the daily Loop discussions is that midweek pause. Wednesday the 10th, it consolidated near profit zone, broke its streak, which led to that critical Loop question in the briefing. Is HPE's pause just consolidation or loss of leadership? That really captures the uncertainty at that moment. Healthy pause, or is the run over?
But it answered pretty quickly. Snap back, reclaiming leadership on Thursday the 11th, up a healthy 1.6%, shrugged it off.
And by Friday the 12th, the Loop briefing confirmed. HPE closed as a beat, breakout $26, new weekly high. Bright green on the heat map. Dual leadership confirmed alongside USPH. That whole arc, breakout, uncertainty, decisive reclaim, it's a powerful illustration of the market confirming conviction.
Speaking of USPH, US Physical Therapy, another strong one, but in healthcare. Started Monday as match, early momentum performed as expected, but with positive signs, then just built momentum higher Tuesday.
Right, and USPH also finished the week as a beat. Exceeded expectations, had the strongest momentum close, also bright green, joined HPE in that leadership spot. Great example of a stock catching a strong bid. Even while its sector was seen as more defensive, it really carved out its own sort of growth story within that safety net.
Then, HSY Hershey, the defensive stalwart, consistently a match all week, performed as expected, steady-handed in a volatile market.
Yep, delivered that beat, plus 0.9%. 3-day streak, strong defensive momentum by Wednesday. Its orange heat map status by the end, solid, but not breakout, just underlined its role. Consistent, defensive, providing stability when things got choppy elsewhere. Showed how steady performance can be a winning play when conviction is shaky.
Okay, now the stark contrast. WU Western Union. Consistently tagged by Loop as lag bottom performer, underperformed big time, had that red streak, consecutive down days, hit a new low Tuesday, September 9th, just seemed like it couldn't find a bottom.
No, it really couldn't, and it got worse. By Wednesday the 10th, Loop reported a 7-day streak of declines in an extended caution zone, that Loop designation for prolonged weakness, high risk. Then it hit an 8-day streak, still locked in caution zone on Thursday. The briefings hammered it. WU continues red streak on the 9th. W locked in caution zone on the 11th, a clear, persistent negative signal.
And closed the week with a fresh weekly low, confirmed as the weakest EV % Loop signal for lowest earnings visibility or appeal. Red on the heat map. Just a tough week, highlighting that huge divergence we saw.
And if you connect all this back to the bigger picture, what's really fascinating, what the Loop market briefings really light up, is how the institutional money was moving. That flow gives you a critical window into the broader sentiment. There were very clear risk-on, risk-off dynamics playing out all week.
Absolutely. You could see the institutional flow rotating. Between growth, things like tech and communication services, when sentiment felt more risk-on, and then shifting into defensive assets, healthcare, staples during those risk-off moments. Strong tech inflows early and late week. But defensive inflows picked up during downturns, like Wednesday when tech cooled off. This isn't just theory, right? It's how big funds actually manage their money, shifting capital based on perceived risk and opportunity.
Exactly. And the Loop briefings gave concrete examples. September 9th, tech inflows, healthcare rotation steady, financials weak. Simple as that. Then the 10th. Defensive inflows into healthcare staples, tech cooled. That dynamic rotation, that's a key takeaway. Shows almost surgical precision in allocating capital. A market managing growth and protection at the same time.
So that raises the question, what about the sectors just left out? The ones that couldn't catch a break? The opposite of those careful rotations.
Well, you definitely had that clear disfavor for certain sectors. The constant reporting of drained funds from energy and financials, like on the 11th, energy financials drained, that really highlights a lack of conviction, a persistent lack. It wasn't temporary. When funds are consistently drained, it means money is actively leaving, not being reinvested. Signals a fundamental concern institutions had. A deeper bearish view on those specific areas during this period.
Okay, so let's wrap this up. We've taken this deep dive into the market, September 8th to 12th, really using that loop daily discussion lens. What are the big picture takeaways you should carry with you from this?
I think to summarize, this week showed a really dynamic market. Active differentiation was key. Tech, specific healthcare names, certain staples showed real leadership or resilience. Institutional money flowed into those areas. Strong conviction shown there. But conversely, funds were consistently pulled from financials and energy, a clear shift away from those sectors. And the individual stocks, like HPE and USPH, they underscored the gains possible with that institutional backing. While WU, a stark reminder of what happens when that conviction disappears. It was definitely a week that rewarded careful sector picking and highlighted just how powerful that institutional flow can be.
That's a great summary of a really eventful week. Really pulls together the key themes from the loop analysis. And as we finish up, maybe a final thought for you to chew on. Given how fast leadership shifted and rotated, even just within this single week, tech leads, then defensives, then back to tech, what indicators do you prioritize? How do you tell the difference between a temporary adaptive move, maybe a fleeting short squeeze, and a truly sustainable market leader backed by real, lasting institutional conviction? Something to think about for your next deep dive. Thanks for joining us.